Welcome to this explainer. Today, we're taking some seriously complex financial data and turning it into a clear, actionable roadmap. You know, our data shows you guys absolutely love hunting for hidden gems, and that's exactly what we're doing today. We are venturing into a corner of the market that almost everyone else has completely abandoned, and we're going to uncover exactly why the absolute last pick might just turn out to be your very best bet.
Because right now there is a totally wild contrast happening in the financial markets. Look at the S&P 500. It is sitting at record highs, trading at a price-to-earnings ratio of 31. Let's put that into perspective. You're essentially paying $31 for every single dollar of earnings. It is literally the most expensive it has ever been. The broader market is pricing in absolute perfection for these large-cap companies. But here's the thing. When perfection is priced in, you have virtually zero margin for error. Just one missed earnings target, boom, a massive sell-off. But then you look over at the Russell 2000, which is the index for small-cap companies, and it's carrying a multiple of only 18. So what does this mean for us? It means it is time to pivot. We need to look at the stocks that the broader market has just left for dead.
So here's our roadmap for today to help us navigate this massive valuation discount safely. We are going to cover the small cap value gap, the Mr. Irrelevant metaphor, the $709 billion debt wall, avoiding value traps, negative enterprise value, and finally, the Q4 pressure point. Let's get right into it.
Number 1, the small cap value gap, an historical anomaly. Okay, so this current era of large cap dominance we're living through, it's actually a massive historical anomaly. Seriously, if you look all the way back to 1927, small caps have historically outperformed large caps by an average of 2.85% every single year. Normally, you get rewarded for taking on that slight extra risk of buying a smaller company. But the streak of large cap dominance that kicked off in 2011, it is the longest one on record. For a decade and a half, capital has just aggressively crowded into a handful of mega-cap tech monopolies, and it's left basically everything else completely starved for investment. And that prolonged streak has created this staggering 42% valuation discount that's peaking as we head toward 2026. This sheer level of divergence means there is incredible room for a profound value rotation right back to historical norms.
Moving on to number 2, the Mr. Irrelevant metaphor. Finding the hidden gems.
Now, if you follow football at all, you probably know the story of Brock Purdy. He was literally the last pick in the NFL draft. They officially call that player Mr. Irrelevant. And what did he do? He ended up leading his team all the way to the Super Bowl. Well, in the financial markets, these neglected microcaps in the bottom decile of the Russell 2000 are the exact same thing. They are completely, totally ignored by the giants of the industry. Wall Street analysts don't even cover them, and the big funds won't buy them. But just like we've seen in sports, sometimes that very last pick turns out to be a generational talent. In the equity markets, this severe institutional neglect creates a highly profitable, totally unique opportunity for retail investors. You know, the ones actually willing to do the fundamental research and look where the big institutions absolutely refuse to.
And the absolute most crucial thing to understand here is the actual mechanics of this neglect. Massive funds literally cannot buy these stocks without artificially moving the market. We're talking about companies with market caps somewhere between $300 million and $2 billion. Imagine a massive, multi-billion-dollar pension fund trying to take a meaningful 5% position in one of these microcaps. Because the daily trading volume is so light, just the mere act of that fund trying to buy those shares would trigger a huge price spike. They'd basically be bidding the price up against themselves, which violates all their internal risk and diversification rules. So, because these big players are structurally locked out by their own sheer size, it creates this huge arbitrage gap. This liquidity gap is basically a pristine hunting ground where mispriced opportunities are just waiting solely for the retail investor.
Which brings us to number 3, the $709 billion debt wall, the abyss.
But before you go out and buy every tiny stock you can find, we have to talk about the danger lurking in the background. Small caps are currently sitting on a truly staggering $709 billion debt maturity wall over the next 2 years. We were talking about roughly $368 billion that has to be rolled over in 2026, and then another $341 billion right after that in 2027. For companies of this size, $709 billion is an astronomical amount of money. It makes up a massive chunk of their overall enterprise value. And guys, this isn't some distant theoretical problem for the next decade. No, this is a massive financial reckoning, and it is happening right now.
And it gets scarier when you look at the type of debt these companies actually hold. The S&P 500 only has about 6% of its debt tied up in floating rates, but the Russell 2000 try a whopping 32%.
Think about floating rate debt kind of like an adjustable rate mortgage on a house. If one of these small cap firms locked in their financing at a 0.5% base rate a few years ago, having to suddenly refinance in a 3.75% base rate environment is like a catastrophic overnight spike in their monthly payments. And remember, that is before you even add on the widening credit spreads that banks are going to charge them just for being risky small caps. Their interest expenses are basically about to explode.
Which leads us to a pretty brutal truth. A whopping 42% of Russell 2000 companies are completely, utterly unprofitable right now. This is where retail investors get crushed. They often buy quote-unquote cheap small caps just based on the nominal share price, thinking a $3 stock is somehow fundamentally a better deal than a $300 stock, and they completely ignore this reality. These unprofitable companies are not true value stocks. They're speculative value traps that rely on a constant stream of cheap capital just to keep the lights on. But at today's higher interest rates, that capital is suddenly prohibitively expensive. Bottom line, a lot of these companies are simply not going to survive the rollover.
And that perfectly tees up number 4, avoiding small-cap value traps. Benjamin Graham, who was widely considered the father of value investing, once famously said, "The secret to successful investing is figuring out the value of something and then paying a lot less, investing with a margin of safety." If we want to survive this impending debt wall, we have got to apply this old-school banking wisdom. We must demand a strict margin of safety. How? By focusing on tangible book value instead of just speculative hype about what their earnings might be in the future. Tangible book value means actual, hard assets that you could theoretically liquidate tomorrow if you had to. We're talking factories, real estate, patents, actual cash in the bank, minus whatever liabilities the company has. We want companies backed by real physical substance, not just a catchy ticker symbol and a prayer.
So how do we actually do this efficiently? Well, we can use a classic metric called the Graham screen. It's a really simple step-by-step filter. You take the price-to-earnings ratio and you multiply it by the price-to-book ratio. If that final number comes out to under 22.5, it's generally considered a safe, defensive, value-oriented stock. Why does this work so well? Because it perfectly balances earning power with actual hard assets. Think about it. If a company has a higher PE ratio, let's say 15, then it has to have a really low price-to-book ratio, like 1.5, just to stay under that 22.5 threshold. This one simple formula wraps up the current price, the expected return, and the physical safety of the investment into a single mathematical test. It efficiently strips out the expensive, risky assets, leaving us with a highly targeted list of stocks to investigate.
So, every single time you evaluate one of these bottom decile stocks, you really need to ask yourself one fundamental question. Am I looking at a zombie or am I looking at a fortress? Let's break down the real-world difference here. A fortress company, something like Watts Water, makes physical, essential infrastructure, valves, water filtration systems, stuff we actually need. They have an interest coverage ratio greater than 5 times. That means they generate 5 times more operating profit than they actually need to pay their debt interest. They have a return on invested capital above 15%, and they're just pumping out steady free cash flow. On the flip side, you have a zombie company, like Shutterstock. They might be facing heavy technological headwinds from things like generative AI. A zombie usually has an interest coverage ratio below 1.5 times, which means almost every dollar of their profit is going straight out the door just to service their debt. With negative or totally stagnant earnings growth, these zombies are incredibly vulnerable to the approaching debt wall, while the fortresses, they are perfectly positioned to just sail right on through it.
All right, let's move to number 5. Negative enterprise value explained.
Now, here is the ultimate payoff for this strategy. Finding companies that the market is essentially paying you to own. Seriously, let's break down the math. Enterprise value equals market cap plus debt minus cash. When a stock has so much cash sitting on its balance sheet that it completely exceeds its market cap and its debt combined, the enterprise value actually goes negative. Think of it like this. It's the equivalent of buying a wallet that has a crisp $100 bill inside of it, but you only have to pay $80 to buy it. You are literally paying less than the raw cash value. Because of their neglected last pick status, some of these microcaps have been so aggressively oversold that the pure cash sitting in their bank accounts is worth more than it would cost to buy every single outstanding share of the company. When you find this, you have found an extreme liquidity anomaly.
So, I know you're wondering, where exactly do we find these anomalies? Well, there are 3 specific small-cap archetypes that make up your prime hunting ground for these hidden gems, the ones with enough cash armor to survive the coming refinancing crunch. First up, we have the overcapitalized tech orphan. Picture this, a company that raised, say, $500 million during that wild SPAC and IPO boom back in 2021. The hype completely died, their stock totally crashed, but hey, they still have $300 million sitting untouched in the treasury, even though their market cap is only $150 million. Insane, right? Second is the domestic manufacturer.
These are your old-school industrial firms that are quietly benefiting from global supply chain reshoring, and they are heavily backed by extremely valuable tangible assets like actual land and heavy equipment. And third, the safety haven utility or staple. These are incredibly boring but super stable companies that provide essential services and consistent dividends. And here's the kicker. They smartly locked in long-term, fixed-rate debt before all the rate hikes even happened.
And finally, we arrive at number 6, the Q4 pressure point. 39%. A staggering 39% of these hard debt maturities for small caps are concentrated specifically in the fourth quarter of 2026. What does this mean for us? It means the separation between the strong fortress companies and the collapsing zombies is going to happen incredibly fast. Companies that cannot secure their refinancing by October of that year are going to hit a hard, unyielding wall as regional lenders become highly selective and start pulling back on credit. The timeline on this isn't years away. It is accelerating rapidly.
Which brings us to the ultimate question you have to ask yourself. Will you be holding a fortress or a zombie when that Q4 refinancing clock finally runs out? The window to act on this is rapidly closing. Retail investors who are blindly holding on to floating rate value traps are staring down massive wipeouts. But for those of us who strategically filter for tangible book value and massive cash reserves, well, we stand to buy literal dollar bills for 50 cents. The broader market has left these Mr. Irrelevant stocks completely for dead. So the only question left is, are you ready to draft them?